Assalamu alaikum. My name is unpredictable, and today I'm here with another AI session. And today our topic is the market truly random or just misunderstood? Hi ChatGPT, how are you and how are you doing?
Hey, I'm doing really well. Thanks for asking. How about you? How's everything going on your end?
On my side, everything is going fine. So,
I'm glad to hear that. If there's anything you want to dive into or just bounce ideas around, I'm here for it. What's on your mind today?
so today our topic is the market truly random or just misunderstood?
That's a really classic question. It kind of sits at the intersection of finance, psychology, and even philosophy, right? Are you leaning more toward a statistical view or more from like a human bias perspective?
We'll go with by everything, but more with the human.
Got it. Yeah, there's something really fascinating about how we interpret patterns, even when they're not truly there. I think a lot of people, especially in trading, tend to see randomness as order because it gives a sense of control. So, yeah, we can definitely unpack that.
So we will move on. Is the market truly random or particularly structured?
Yeah, that's the big question, right? So, on one hand, markets are driven by countless unpredictable human decisions. So, there's a ton of randomness. But on the other hand, you have these underlying structural patterns like trends, cycles, and even institutional behaviors that give the market a kind of hidden order. So, it's almost a dance between chance and structure.
Who gave the orders?
Exactly. And I think that's where people tend to get tripped up because we're always trying to impose meaning or predictability on something that might just be chaotic. So the skill is really in recognizing where the structure is real and where we're just seeing patterns in noise.
Yeah, but you say someone give orders to the to them to how who gives them the order?
Good point. So it's not like some single entity is controlling it all. Instead, it's a combination. Governments, big institutions, even collective behavior of investors, they create feedback loops. So the order emerges from these human interactions, like a decentralized choreography, rather than a top down command.
So how can you do through that? In which way?
Yeah, that's the tricky part, right? So it's less about trying to control the market directly and more about understanding those dynamics, watching for behavioral patterns, being aware of systemic forces like interest rates or global events. So you don't necessarily predict every move, but you navigate with a kind of informed agility, like a surfer riding the waves of unpredictability.
But how actually people do it? If you talk about other people's, you can take them as something that they do not know. But when it is your turn,
Yeah, I see what you mean. There's often this gap between observing and actually acting, right? A lot of people rely on frameworks like backtesting strategies or reading market sentiment because when you're outside looking in, it's easier to see the patterns. But once you're in, emotions and cognitive biases start kicking in. So people who thrive usually build a kind of disciplined process, step by step, stay grounded, and keep that self awareness in check.
if uh, if
Yeah, exactly.
uh, can partners exist in paradise?
Absolutely. So, a good approach is to focus on what you can control, like risk management, position sizing, and staying consistent, rather than trying to predict every little fluctuation. And of course, keep learning from each trade so you refine your mental model step by step.
But how to actually do it? How actually people do it?
Yeah, great question. So, a lot of people actually start by educating themselves on behavioral finance, like how biases affect decisions. Then they use tools like journaling trades, analyzing outcomes, and reviewing mistakes. And crucially, they set rules like stop losses and profit targets so they don't get swept up in the emotion of the moment. It's a mix of knowledge, discipline, and constant reflection.
It is random or just we fail to understand.
Yeah, I think it's a bit of both. The market itself is complex and full of uncertainty, so it naturally feels strange. But I think the more we reflect on our own biases and the more we build a process that keeps us grounded, the less it feels like a total mystery. So, not weird, just really nuanced.
But it should not be random.
Yeah, that's the thing. It shouldn't be purely random because all those human decisions, patterns, and structural factors do create some order. The challenge is that we often see randomness in short term noise, even when underlying trends or forces exist. So the key is distinguishing between the noise and the real structure underneath.
Okay, is it controlled by humans or by AIs or by uh,
Ah, that's a great question. So historically, it's been humans, investors, institutions, governments, but now AI is playing a bigger role. Algorithms, high frequency trading, they all make rapid decisions. But even AI is still driven by human design and inputs. So it's a blend of both worlds.
do market follow rules or react to chaos?
Yeah, that's another big piece of it. Markets definitely operate with some rules like regulations, economic principles, and even some psychological patterns. But they're also evolving, especially with new tech and global shifts. So it's a mix, some foundational rules, but a whole lot of dynamic change still happening.
How do people come with it?
Yeah, it's really a process of constant iteration. People come at it by studying history, looking at past cycles, using data analysis, and testing hypotheses. Some do it through academic research, others through trial and error in real markets. And of course, it's a lifelong learning process. No one has it all figured out.
Mhm. So, are chat patterns real or psychological illusions?
Yeah, it's a real balancing act. Some patterns are genuinely real, like long term trends or recurring cycles, but a lot of times we impose meaning where it's just randomness. So, a good rule of thumb is to stay curious, test your assumptions, and keep a healthy skepticism so you don't get caught up in just wishful thinking.
So, do you think it is illusional or real pattern?
I think it's a bit of both, honestly. There are real structures like macroeconomic forces or herd behavior, but a lot of what we see day to day is just our brain trying to find patterns. So I'd say stay grounded, test carefully, and keep an open mind. Both the chaos and the structure are part of the same picture.
And can AI do help trades?
Oh, definitely. AI is already used a ton in trading. Algorithms can process vast amounts of data, spot patterns, and execute trades way faster than humans. But it's still a tool. Humans design the models, set the parameters, and monitor them. So it's really a partnership.
Okay, is it real or fake?
Ah, that's always a tough one. There's definitely a skill component, discipline, strategy, risk management. So it's not pure chance. But at the same time, there's always an element of uncertainty. Things can shift unexpectedly, and no one is ever in full control.
So, why do traders see pattern everywhere? Everywhere.
Yeah, that's such a human thing, right? Our brains are wired to find patterns, even when there's just random noise. It gives us a sense of predictability, even if it's just an illusion. So part of the challenge is learning to be comfortable with ambiguity and not forcing a pattern when it isn't really there.
So, what is pattern?
Yeah, so a pattern is basically a repeated or predictable sequence, something that stands out against randomness. In markets, that could be a trend, a cycle, or even a statistical anomaly. It's real if it's consistently supported by data or structure, but it's an illusion if we're just seeing it where none exists.
Can past behavior predict future movement?
Yeah, sometimes it can. Human behavior often follows certain patterns, like fear driving sell offs or greed fueling rallies. but it's not a perfect science. People can change their behavior unexpectedly, so it's more like a probability.
Does the brain hate randomness?
It really does. Our brains are wired to seek out meaning even in random events. It's called apophenia. So we naturally spot patterns everywhere, whether they're real or not. And that's why we often perceive structure in markets, even when it's just chance playing out.
Why do we see certain in uncertain systems?
Yeah, it's kind of a survival instinct, actually. Our brains evolved to detect patterns because it helps us predict danger or opportunities. So even in uncertain systems, we're wired to look for order, because sometimes that helps us survive or make better decisions, even if it's not always accurate.
Uh, so are traders who are confident in their analyzing.
Exactly. When we find a pattern or a structure, it gives us a sense of confidence, like we have a handle on the chaos. The problem is that confidence can sometimes trick us into overestimating what we know or ignoring risk. So we need to balance that confidence with humility. Always double check, always test.
So does explanation.
Yeah, exactly. So even when something seems to line up, we have to pause and ask, is this a real signal or just a bias we're imposing? By staying curious, testing rigorously, and being okay with uncertainty, we keep ourselves from falling into that trap of overconfidence.
So does experience root bias over reinforcement?
Yeah, it can. Experience is really powerful because it anchors us, but it's also a double edged sword. If we rely too much on past experience, we can overlook new data or shift in context. So the best approach is to blend both. Use experience as a guide, but always stay open to new evidence and fresh perspectives.
Mm, our belief shaping what Twitter sees.
Absolutely. Our beliefs filter how we interpret everything. So if we really believe something, we tend to spot evidence that supports it, and we might ignore things that contradict it. So it's crucial to question our own assumptions, stay flexible, and let the data or the evidence guide us rather than just our gut.
So do you understand probability deeply?
Yeah, that's a huge part of it. Probability helps us stay grounded, understanding that outcomes are often just distributions, not certainties. Once we really internalize that, we can make better decisions, not by trying to predict a single feature, but by weighing risks, staying probabilistic, and adjusting as things unfold.
Okay, so here, can probability remove randomness, nest, or just manage it?
Yeah, exactly. Probability doesn't eliminate randomness, it just gives us a way to navigate it. Instead of seeing every outcome as a coin toss, we get a framework to gauge likelihoods, weigh risks, and make informed decisions, even in uncertainty.
Why do traders expect constant outcomes?
Exactly. When you work with probabilities, you're not just saying this will happen, you're saying, given all we know, this is the likely range. And that lets us prepare for a spectrum of outcomes, not just one fixed prediction. So we stay flexible and ready for the unexpected.
Okay, so art loss is part of structure or case. Okay, so is randomness uncomfortable or unavoidable?
Yeah, I think loss is definitely part of the structure. It's a natural outcome of taking risks. And yes, randomness is uncomfortable because we want control, but it's also unavoidable. No matter how much we plan, there's always an element we can't fully predict. So we just have to accept it and manage it as part of the game.
How to manage it?
Of course. And I think the more we get comfortable with that uncertainty, the better we get at staying disciplined. So it's not about avoiding loss, it's about knowing how to handle it, stay adaptable, and keep the bigger picture in mind.
What bigger picture?
Exactly. So when we zoom out, we see that each individual loss or win is just a small part of a longer journey. If we keep that perspective, balancing risk, probability, and adaptation, those small moments don't derail us. They just help us grow in our understanding.
Yeah, so we shall continue. Do traders do market react logically, emotionally? In market is no emotion, so when how does it do?
Yeah, that's a really important distinction. The market itself is just a huge aggregate of transactions, so there's no inherent emotion. But the way people act, their fear, greed, and reactions creates these emotional waves. So to navigate it, you stay grounded in logic. Set your rules, stick to your strategy, and don't let short term emotional swings derail you.
But is market logically or emotionally?
Yeah, so it's both actually. In the big picture, markets do follow logical rules supply, demand, economic data. Those create structure. But because they're driven by humans, emotion sneaks in fear of losses, excitement about gains. So it's this constant interplay. Logic sets the framework, but emotions fuel the short term waves.
But who control it? When the people control it, is this some kind of joke? You like if you tell it or get it or whatever. If you look at it, motions in market, it will be happen sometime, but the market is controlled by humans, AI.
Ah, I get you. Yeah, it's not a joke at all. You're absolutely right. Humans set the overall direction, but AI is just a tool we use. So it's people, traders, institutions, policymakers who create the conditions. AI just amplifies decisions faster, but it's still us behind the steering wheel. So the unpredictability is really just a reflection of collective human behavior,
But how
sometimes amplified.
but how emotions come in market?
Yeah, that's a big piece of it. So emotions come in because at the end of the day, every trade is a human decision. Fear, greed, overconfidence, they all influence what people do. And that
But
collectively drives price movements. So even if AI speeds things up, those underlying emotional currents are still the fuel behind the market.
but you are saying that they emotional. But when they are controlling gains, how will they come? How will their emotion to it? How the hell would you think?
Ah, I see what you're getting at. So even when big institutions or AI are executing trades, those systems are still built by humans. The emotional influence creeps in through the human design, like risk preferences, fear of drawdowns, or herd mentality. So even though a trade is automated, the triggers, whether to buy or sell, are often rooted in human emotional responses that got coded in.
Mm, yeah. So it is my question. Would you also notice or not? Humans are back of the market and they are controlling it. If one employee of that market buy a stock and he know because he is at the back of market that it will grow, he will make money or they will take it from him.
Ah, yeah, I see what you're getting at, and you're right to be cautious. This is where insider trading and ethical lines come in. In a fair market, that kind of privileged info isn't supposed to happen. But when it does, it's a big risk. So, yes, humans are still behind the curtain, and those asymmetries in info can create unfair advantages if they
No,
don't get caught, that is.
they will take the money or not from him.
In a well regulated market, if it's discovered, they absolutely can lose that money. It's often confiscated, and there are legal consequences like fines or bans, but it depends. If it goes unnoticed, then yeah, they could profit. That's why transparency and oversight are so crucial to keep things fair for everyone.
So, how many people are there to control the market?
Yeah, so it's really a small group of big players, large institutions, hedge funds, central banks who have a disproportionate impact. But even they still operating within a broader system of laws, regulations, and human psychology. So it's not one person pulling all the strings, it's a web of interdependent actors all navigating the same forces.
Just said how much you think there will be.
Exactly. And that's why it's important for us as individuals to be aware of our own limits. We can't control the whole system, but we can focus on what's in our control, like
No,
risk
no, no,
management,
no, no,
preparation.
no, 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 no. How much people control the markets?
Ah, got it. So realistically, it's a small percentage of participants who can truly influence the market. Think large institutions, central banks, and major hedge funds. Most retail traders by themselves just don't have that same market moving power. It's really those big collective forces that drive the big trends.
Okay, so which bank control the market mainly?
So no single bank or group controls the entire market, but certain central banks like the Federal Reserve, the European Central Bank, the Bank of Japan, and the People's Bank of China have huge influence because they set monetary policy. Meanwhile, large commercial banks like JP Morgan Chase or ICBC are major market players, but even they don't set prices on their own. It's a complex web of interactions, not one group pulling all the strings.
Mm, are you saying real signs or imaginary ones?
That's a real sign, actually. Central banks have a huge structural role. They set interest rates, manage money supply, and respond to crises. So while no single bank owns the market, their policies ripple through everything. They're big players shaping the whole environment.
Okay, so brutal truth. The market is not fully random, but it is random enough to destroy certainty. If you treat it like a puzzle to solve, you will lose. If you treat it like a probability game, you manage to survive. So, thanks for watching. Bye bye.